Good evening. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Wednesday, March 2nd, year of our Lord 2022. And I want to talk today about estimated taxes. Most of my clients are small business people, and they generally have to pay quarterly taxes, estimated taxes. We're going to talk about that. Won't you join us? Yeah, well, that's what we're, again, it's tax time, so we're thinking a lot about this these days, about the IRS and our taxes. And as I mentioned, most of my clients, they run their own business. And most people who run their own business are supposed to pay quarterly taxes because, it's based on what you paid, what your tax bill was last year. So if I owed $12,000 last year, I'm supposed to pay per quarter $3,000. 3 times 4, $12,000. Pay the IRS. And many people don't even really understand that. I think a lot of accountants don't even explain it very well. And you may not even know that you're paying the penalty. It's called the penalty for underpayment of estimated tax. So let's see what the IRS has to say about that, about the penalty for, make sure I have this on right. I do. So let's see if we can, see, I said I had it on right, but then I didn't. Wait, let's see if we can get this. There we go. So this is what the IRS talks. It's topic 306, right? It's very exciting. But it is exciting. Okay, so my job, generally my job is when we do a tax is compliance. Right? We want to get you in compliance. Let me go back here because I think this is an important discussion. So people come to see me. So today, matter of fact, I was just overlooking some tax returns. We went back and did 5 years or 6 years of tax returns. A lot of people haven't filed their tax returns in a number of years. And, the good news is you don't always have to go back. So I've had clients who haven't filed in 20 years. Does that mean, Attorney Leahy, you have to go back 20 years and do the tax returns? The answer is no. You don't generally have to do that. The IRS they call you in compliance if you file for the last 6 years. So you want to go ahead. Now, they can make you go back further, but usually they don't. You have to go back and file for the last 6 years. Well, here's the truth. After a certain point, it really doesn't matter what I owe the IRS because I can't pay them. Right there, you come to a point where it doesn't really matter anymore. And so if I haven't done my taxes in 6 years and I go back and do 6 years of tax returns, that number that I'm going to owe is probably, with penalties and interest and all of that, is probably more than I can ever pay. And so it doesn't really make sense to go back and try to do some tax savings on these tax returns. They're called compliance returns. So you go back and you do these returns to get in compliance with the IRS. It really, says, well, I had this expense, you didn't put it in. So, well, what, it's going to save you $300? I mean, you owe so much money, the $300 won't make a difference, right? So now, once you get in compliance, and then this, and I've talked a lot about this on this show and elsewhere. The secret to solving IRS problems, and again, we want to solve IRS problems forever. Here's the secret: compliance, and file your tax return to come up with a plan for the IRS. The secret is stay in compliance. Once you get in compliance and you want to stay in compliance, well, now we can start talking about tax planning and lowering your tax bill, right? And you always want to lower your tax bill. And one way to lower your tax bill, first you got to do the easy things, right? One of the easy things is avoiding these penalties. Penalty for so let's go back to this now, okay? So to avoid the penalty for underpayment of estimated taxes. So let's just look at what the IRS says about this. And this is really, and most people don't really understand this. The United States income tax is a pay-as-you-go tax system, which means that you must pay income tax as you earn or receive your income during the year. You can do this either through withholding or by making estimated tax payments. If you didn't pay enough tax throughout the year, either through withholding or by making estimated tax payments, you may have to pay a penalty for underpayment of estimated taxes. Generally, most taxpayers will avoid this penalty if they either owe less than $1,000 in tax after subtracting their withholding and refundable credits, or if they paid withholding and estimated tax of at least 90% of the tax for the current year, or 100% of the tax shown on the return for the prior year, whichever is smaller. Therefore, there are special rules for farmers and fishermen because their income fluctuates so much. Certain household employers and certain higher income taxpayers. For more information, refer to, of course, there is more information. Generally, taxpayers should make estimated tax payments in 4 equal amounts to avoid a penalty. However, if you receive income unevenly during the year, you may be able to vary the amounts of the payments to avoid or lower the penalty by using the annualized installment method. And you have to fill out a form, and you can't just do it. Right? You have to tell them this is what I'm doing, and they have to approve it. To see if you owe a penalty for underpaying your estimated tax, the law allows the IRS to waive the penalty if, and here it is, it's very limited. You didn't make a required payment because of causality, event, disaster, or other unusual circumstance, or if and it would be inequitable to impose a penalty on you. So if you become disabled or something like that, or you go through a disaster, and you miss a payment, they'll excuse it. You retired after reaching age 62, because you can't retire before that, or became disabled during the year or in the preceding tax year for which you should have made estimated payments, and the underpayment was due to reasonable cause and not willful neglect. Okay, so this is what the IRS calls. Now, every year, there's what they call the Taxpayer Advocate. They say, well, it's an independent part of the IRS. It's part of the IRS. I don't know how independent, but the Taxpayer Advocate is to advocate for taxpayers, as the name implies. And every year, the Taxpayer Advocate comes up with a report. Remember, we talked about a report on this show a couple weeks ago because the Taxpayer Advocate warned us about the 2021 tax season, here in 2022 tax season, I guess, for the 2021 return, and warned us that the IRS was in crisis, and that was in her report. But that report covers a lot of things. So also in that report. So let me see if we can. Let me go up here and so this is her annual report, and in the annual report, she has things. She makes recommendations. So here's the annual report to Congress, the National Taxpayer Advocate report to Congress, and so there's a summary, and then the National Taxpayer Advocate 2022 Purple Book. It's a compilation of legislative recommendations to strengthen taxpayer rights and improve tax administration. There's lots of this, and we could go and we'll go over some of this in future episodes. Let me get rid of some of this stuff here. Sorry. Okay, and I think it's number 30. Let's go down to number 30, where she reform penalty and interest provisions. So she's asking to reform this provision, the underpayment estimate. So here's her recommendations. Okay, so here's the reform penalty and interest legislative recommendation number 30, as we just saw. Convert the estimated tax penalty into an interest provision to properly reflect its substance. Okay, so they're not trying to say that you shouldn't pay it. They just want to recategorize it. They want to call it something different. This is government at its best. Okay, this is the government, not trying to. They don't want to change it. It's just how they present it to you that's important. Through the combination of wage withholding and estimated tax payments, the IRS, this is the Internal Revenue Code, aims to ensure that federal income and payroll taxes are paid ratably throughout the year. Generally, the code requires employers to withhold tax on wages paid to employees. It also generally requires individual taxpayer to pay at least the lesser of 90% of the tax shown on the tax return for the current year, or 100% of the tax shown on the tax return for the preceding tax year, reduced by the amount of wage withholding. In 4 installments, payments due on April 15th, June 15th, September 15th, and January 15th of the following tax year. The code generally requires corporate taxpayers to pay at least 100% of the tax shown on the tax return for the current tax year, or in some cases, 100% of the tax shown on the tax return for the preceding tax year in 4 installments. Same thing here. Now, remember, generally when I'm advising people, and remember, as I mentioned, my clients own their own business. One of the things after you get in compliance with the IRS, and we can start talking about your taxes and reducing your tax liabilities in the future, one of the things I'm going to recommend is a business structure, an S corporation or something like that. Now, S corporations are what they call flow-throughs, which means that generally they don't pay income taxes, these corporations, because it all flows into the personal tax return of the owner. That's usually how it works. And so when I talk about corporate taxes, it really doesn't affect many of my clients. I don't have a lot of corporate clients. Again, business people who own a corporation, but they're generally what they call the subchapter S corporations. We should probably do a show on that too. Okay, so the code provides that the taxpayer who fails to pay sufficient estimated taxes will be liable for a penalty that is computed by applying the underpayment rate established under the code to the amount of the underpayment for the period of the underpayment. The code is an interest provision. Therefore, the additional amount a taxpayer owes for failing to pay sufficient estimated taxes is computed as an interest charge, even though it is denominated as a penalty. So there's hey, we shouldn't call it a penalty because it's really not a penalty. It's just a interest on money you're supposed to pay. So it shouldn't be called a penalty. I think it sounds, it feels like a penalty, sounds like a penalty. It should be called a penalty. But here's why they want it. Here's the reasons for the change, according to the Taxpayer Advocate. For a variety of reasons, taxpayers often have difficulty predicting how much tax they will owe. Self-employed taxpayers or taxpayers who own small businesses may experience significant fluctuations in their incomes and expenses from year to year. Well, that's totally true. Similarly, taxpayers with sizable investment income may experience significant fluctuations. In addition, substantial changes in tax laws, such as those that took effect in 2018, affects tax liabilities in ways that taxpayers may not fully anticipate. As a result, millions of taxpayers do not satisfy for the requirements of the code and are liable for penalties, even though many have attempted to comply. Corporate taxpayers face similar challenges. The term penalty carries negative connotations, and the National Taxpayer Advocate believes it should be reserved for circumstances in which the taxpayer has failed to make reasonable efforts to comply with the law. Thus, she agrees with the assessment of the House Committee on Ways and Means when it wrote during a previous Congress, because the penalties for failure to pay estimated tax are calculated as interest charges, the committee believes that conforming their title to the substance of the provision will improve taxpayers' perceptions of the fairness of the estimated tax payment system. So they don't want to affect the fairness of just your perception of it. This is the government, again, at its best. Along these lines, the Office of the Taxpayer Advocate has concluded research studies that have found tax morale has an impact on tax compliance. Okay. When the IRS imposes a penalty on a taxpayer, there is a strong implication that the taxpayer has engaged in improper conduct. But haven't they? Because they haven't paid the tax what they're supposed to. For that reason, penalties generally should be subject to waiver for reasonable cause, and interest payments are not subject to reasonable cause. Under current law, the estimated tax penalty cannot be waived because under current laws, the statute says that the IRS must charge interest. Thus, an individual who experiences a fire, flood, heart attack, or other exigent circumstances that precludes payment of the estimated tax deadline will still be penalized. This is not good for tax morale. It's also not good for your pocketbook. If the addition to the tax is recharacterized as an interest charge designed solely to compensate the government for the time value of money, it would be easier to justify imposing it without waiver. So they don't want to change anything. They don't want to change that. They're just going to say, hey, let's just call it something different. So here's the recommendation. Recharacterize the penalty for failure to pay sufficient estimated tax as an interest charge, which is the basis for the calculation. Toward that end, the code from the Part 1 of Subchapter A of Chapter 68 to the end of Subchapter C of Chapter 67 and make conforming modifications to the headings and text. If a failure to pay sufficient estimated tax continues to be treated as a penalty, enact a reasonable cause exception so that the penalty will not apply when a payment is late due to circumstances beyond the taxpayer's control, such as fire, flood, or medical condition that makes compliance impractical. So again, they don't want to change it. They don't want to change the rules just based because they're wrong or because they're unfair, because it affects tax morale. And tax morale might affect compliance. So this is what our government is worried about. But suffice it to say, I wanted to point this out because it's important that you, again, if I'm trying to reduce my tax burden, well, the first thing I should do is do the easy things. Avoid penalties. So file my tax return on time. Because if I don't file on time, I get a failure to file penalty. And also try to pay my taxes on time. Because if I don't pay them on time, then I'm subject to a failure to pay penalty. And one thing that they're telling, the time value of money, the IRS, what they do is they charge you interest rate and they compound it daily. So it has a big effect. And again, when people haven't paid for some years, that number, just because of the interest, I can't, almost everybody that hires me wants to say, I don't mind paying the taxes, but the penalties and interest, can we get rid of them? And the answer is not usually. Again, sometimes you don't have to pay them because you'll never be able to pay them. But if I have assets and I have the money to pay them, then the answer is I'm going to pay them because that's just the way the IRS works. Okay. So anyway, I thought that was an interesting discussion. I face this a lot with my clients with the estimated tax payments. I think a lot of people don't do it. First, people don't even realize when you get your tax, if you have an accountant and they give you your tax return, with that tax return are vouchers for each quarter in the next year, right? So again, as I mentioned, if I owe $12,000, I'm going to get 4 vouchers, and those vouchers are going to say $3,000 due by April 15th, $3,000 due by June 15th, $3,000 due by September 15th, $3,000 due by January 15th. Okay, so that's what you're going to get a voucher. And I can't tell you how many people I've talked to, they never even notice it. Their accountants never pointed out to them. And then they pay the penalty. They don't even know they're paying the penalty, but they are paying the penalty. Again, so if you're trying to lower your tax burden, and who isn't, first thing you got to do is the easy stuff, right? Take the deductions that you're entitled to. Avoid penalties that you can avoid. That's where you begin. Okay, so thanks so much for joining us here. We're going to ask you to like and subscribe. Like and subscribe to the page. We got to get this information out there. People have to know about this stuff, and they don't. So we're trying to teach them. So help us get the word out. We thank you so much for helping us. And I sent out another book today. And the book that I have is Deal with Your IRS Problem Today. Again, if you're facing IRS problems, what's the first thing you should do? Get a copy of my book, Deal with Your IRS Problem Today. It'll help you decide what to do. Maybe you can maybe there's enough information in there. Many people could solve their own IRS problems. Just get a copy of the book, Deal with Your IRS Problem Today. Go to freeirsbook.com, freeirsbook.com, and get your free copy of Deal with Your IRS Problem Today. So thanks so much for joining us here today, and I look forward to seeing you again tomorrow. Join us tomorrow, won't you?